Good afternoon and welcome to the Equifax Market Pulse Quarterly Trends webinar, where we're going to be focusing on what's been happening in the third quarter of 2022. For those of you who haven't met me before, my name is Becky Oakes. I'm the Vice President of Analytics here at Equifax. I'm delighted that I will be joined today by two colleagues, Swarnima Pandey, who heads up our Insight Analytics team, and Kathy Katsouleris, who's our VP of Consulting. Now, before we get started, I'd like to hand over to Sandra, who's going to talk to you about the On24 platform and how it works.
Thanks very much, Becky, and good afternoon, everyone. Each area within the On24 platform is responsive, so you can maximize or minimize each widget or box on your screen based on your viewing needs. There's an Ask a Question widget underneath the slide area, so feel free to enter any questions you may have, and we'll address them throughout today's session. In the event there's too many questions to get through, we'll generate an FAQ document, which we'll send to you in the coming weeks. Some related content is available for download in the related content area, and our presentation today in English and French will be available in the coming days. Our session is being recorded, and you will receive the on-demand link via email tomorrow. Some additional features you'll notice on the bottom of your screen are an attendee chat, reactions, register now for our upcoming Small Business Trends webinar on December the 8th, our survey, which will pop up at the end of the webinar, and contact us. Feel free to check any of these out and provide your feedback. Now let's get started, and Becky, back to you.
Thank you so much, Sandra. Okay, so let's get started. As always, I'd like to touch briefly just on any developments that we're seeing on the economic side for this quarter. As we know, this continues to be quite a challenging period, not only here in Canada, but also globally. And there has been some fairly significant movements over the last 12 months. Now, inflation continues to be a really big talking point. And although we have seen a little bit of improvement in a few areas since the middle of the year, we unfortunately are still going a little bit in the wrong direction on some of those key essentials. So energy costs and gasoline, they've fallen since June, but they still remain 17.8% higher than the same period last year. And when we compare to pre-COVID, it's a huge 46.1% higher. Now, this impacts not only consumers, but businesses as well, because it obviously goes into their operational costs, their supply costs, and as a result, that can ultimately lead to additional costs being passed on to consumers in other ways. For some other essentials like food, we aren't really seeing that much improvement yet with the inflation side. We're still more than 10% up compared to last year and almost 17% up when we look compared to pre-pandemic. Now, I think the reality is that although the Bank of Canada is being aggressive with its interest rates hikes to try and curb inflation, and although we may start to see a very slight drop at the moment that we had in the last month, it's going to take quite some time before this really gets back in line with those target levels. Now, whilst inflation, this really is impacting consumers and their day-to-day living costs. Now, as we all know, interest rates have continued to rise, and they're currently sitting at 3.75%, and we've had quite an aggressive stint of increases since the start of the year, so 350 bips in just 8 months. And that's really faster and higher than we've seen in the last 20 years. The good news still remains that there is some buffer for consumers in that although we've seen some really high inflation, we've also been through a period of rising disposable income, especially for some of the lowest incomes in Canada. And this was really driven by those support mechanisms that were put in place during the pandemic, both by the government and also by some of the lenders that were there to kind of offer support on things like payments. The less good news is that some of that buffer has really fallen again, especially for maybe some of the more vulnerable of consumers with those lower incomes. Now, the good news is we have had a strong area in terms of the economy with the labour market. We've seen really low employment rates, and we've seen an increasing number of vacancies in 2021 and 2022. Now, this has contributed to some of those income rises because there has been shortages in some of those key industries, and that's led to quite a competitive market. But it likely isn't equal across all of Canada, so there will be pockets of consumers who haven't benefited as much in terms of income rises, and therefore the battle with inflation without that additional support is going to be a bit of a challenge. When we look at what's happened on the benefit side, that really has tailed off since the COVID months, And although we are still a bit above where we were pre-pandemic, it really has stabilized, and therefore there's less additional support than we had during those main lockdown months. So just in summary, inflation levels are still impacting day-to-day living costs, as well as placing additional strain on certain businesses and industries. And we do expect this is going to be impacting consumers and their credit use. So to find out how, I'm going to hand over to Swanima, who's going to talk you through what we're starting to see on the consumer credit side of things.
Thanks, Becky. We just saw how the economy is changing, and now in this section, we will dive deeper into how it has started to affect consumer credit. Now, debt levels are rising, and so is financial stress among many consumer segments. We are seeing trends revert to 2019 level. Three key areas that we are seeing maximum changes are credit cards, mortgages, and delinquencies. This has been a quarter for credit cards. We have seen a massive jump in new credit card originations. Credit cards have fully recovered from the pre-pandemic setback. We are starting to see higher spending with increasing balance. Overall, credit card utilization has also increased, but a lot of it is being masked by high credit limits on new cards. So essentially, consumers are starting to use their credit cards more. New mortgage originations are fast dropping from the highs of 2021 and are now below the pre-pandemic Q3 2019. Now, home prices are not seeing a similar drop at the same pace as the new originations. Average loan amount on new originations has very small impact this quarter, and it's just a small drop from quarter over quarter. And higher interest rates are pushing average payments higher. Many consumers are now finding themselves locked out of the market. We are seeing financial pressure build. Consumers, as the cost of living and cost of borrowing are increasing, more consumers are missing payments on their loans and on their credit cards than they were missing 12 months back. But the levels are still below pre-pandemic, but early signs of financial stress are visible, and we do expect to see more delinquencies in the coming months. The total consumer debt is at $2.36 trillion. While 75% of this is mortgage debt, the pace at which the mortgage debt was increasing has slowed down owing to the drop in new mortgage originations. But the non-mortgage debt, which has now gained momentum, is increasing at a faster rate than it was 12 months ago. Now, part of it is due to the increase in credit active consumers, which went up by 3.1% from last year. This is compensating from the slowdown we saw in 2020 and 2021 when immigration was restricted, colleges were closed, many new to credit consumers couldn't enter the credit market, but now things are open, new to credit consumers are becoming credit active. But this is one part of the story. Another factor that is affecting the non-mortgage debt level is the rising cost of living. Average non-mortgage debt per consumer is highest since Q2 2020. We have seen in the past that consumers tend to take more credit when in a financially stressed situation. Hence, we are seeing a rise in revolving debt levels. The biggest contributor to the non-mortgage debt this quarter has been credit cards, owing to its new origination volume, and even the overall credit card balances went up by 14%. But this is still in comparison to the lows that we saw in Q3 2021. But consumers are starting to increase their credit card debt. Revolving lines are also seeing a growth in balance, but it's the secured lending which has slowed down because of the lower new originations. But despite the slower growth in secured lending, overall non-mortgage debt has surpassed pre-pandemic levels. Although this is not true for all provinces, provinces like Prairie and Atlantic provinces continue to maintain lower debt level than pre-pandemic. As debt levels are rising, we also see a rise in delinquencies. Now, early delinquencies are up across all consumer segments, especially for non-mortgage products. All the red arrows that you see here shows the increase in delinquencies. So the first column shows a year-over-year increase in year-over-year change in delinquencies. So we're comparing it to 2021. The second column shows a comparison to the pre-pandemic period, which is Q3 2019. And as you can see, both account and balance level delinquencies are up. consumers have started to miss payments on their loan, card, and even HELOCs. Again, we are starting from a very low point. So delinquencies are increasing from the historic lows, but as you can see in the second column, they are still below pre-pandemic levels. We are yet to see a rise in mortgage delinquencies. They continue to fall year over year, but mortgages usually are the last product where consumers start to miss payments. Another measure of financial stress is insolvencies. While bankruptcies are low, consumer proposals are rising at a faster rate and have already reached 2018 levels, and they're very close to 2019. Now, proposals are usually the ones to rise first because it does not involve you surrendering your assets like you do in bankruptcy. So it is a preferred option for many consumers who seek financial assistance. Provincially, we are seeing variations in delinquency levels. Western provinces, BC, Alberta, and prairies are fast approaching the pre-pandemic levels. If you look at the auto delinquencies for BC and prairie provinces and Alberta have already reached 2019 levels. While credit card delinquency rate is also going up across all provinces, but if you look at the year-over-year number, they're still lower than Q3 numbers, but they are approaching 2019 levels. We are also seeing changes in new originations. So credit card lending has surpassed pre-pandemic levels. 1.4 million new cards were issued this quarter. It's a full recovery from the pandemic slowdown that we have seen all through 2020 and 2021. Now, this growth comes from all consumer segments at all risk levels. So though the proportion of consumers that fall under 620 score group is very small, but the new card originations went up by 16% when compared to 2021. And if you look at credit limits, or new card also went up across all credit segments. Now, when we compare credit limit assigned to new cards in 2022 with previous years, we see a huge increase. This new limit on new card origination is almost up by $1,000 than we have seen in the last 5 or 6 years. While credit card originations rebounded, car loan originations have been slow. The biggest drop is in leases, but that is no surprise. We have seen leasing activity decline since Q3 2020 as car prices are increasing, and in an unpredictable market, leasing is becoming less and less desirable. Apart from leasing, there was also a drop in new auto loans this quarter, even the bank auto loans. Usually we see a high number of new auto loans in Q3, but this quarter, new origination numbers were lower than Q3 2021. And auto in general has been a very volatile market since the pandemic, but supply chain issues are being resolved slowly, and that has led to a small drop in car prices, and hence you see on the chart on the right side, the loan amounts are also starting to slow down. Now we are seeing the same drop in used car loan amounts as well. As you can see on the chart on the left side, used car loan amount skyrocketed in the last 12 months at a very fast rate. And this is the first quarter that we are seeing a smaller increase, a drop in used car loan amounts. Now the proportion of used car loans with 72 plus term is also increasing. This was not the case before. Higher loan amounts have pushed used car terms to 72 plus. Now, so therefore, more consumers now have longer term, higher loan amounts with high payments, which could put many consumers at risk of missing payments. Moving on to mortgages. The mortgage frenzy we saw in 2021 is finally slowing down. New mortgage originations took a huge hit this quarter when compared to 2021. They're down by 23% when compared to Q3 2021, even lower than 2019 levels. This is the first time we have seen new mortgage origination go below 2019 levels. This rapid rise in interest rate in the last 7 months has had a huge impact on new mortgage originations. But unfortunately, we are not seeing the same drop in new mortgage loan amounts. Despite some pricing correction in a couple of markets, the loan amounts are still higher than 2021. They have come down from last quarter, but it will take a longer time for interest rate to start impacting loan amounts. Now, some of the hottest markets saw the biggest drop in originations. Both Toronto and Vancouver mortgage origination dropped by double digits, but with very little impact on the loan amount. Now, one consumer group facing quite a challenge in the housing market is the first-time home buyers. So first-time home buyers are in the time period where interest rates are extremely high, and we expect more rises in interest rate. While house prices are also higher than ever, with very little impact of interest rates seen right now. So the chart on this slide compares year-over-year change in average loan amount and average monthly payments of first-time home buyers. As you can see, the loan amount has rapidly increased from 2020 to 2021, while average payment amount, which are the gray bars, did not see the similar increase. But as of 2022, monthly payments on first-time home buyers are rising year over year. So first-time home buyers in 2020 are paying at least $500 more in average monthly payments for either the same loan amount or higher loan amount. While slowing housing market can be beneficial for a lot of first-time home buyers, prices are slowly stabilizing. This is creating lesser competition in the market, but it is not yet a complete buyer's market, as the high interest rate could push a lot of first-time home buyers out of the pricey housing market. I'll take a pause here and see if we have any questions before I hand it over to Becky.
Thank you so much, Swarnima. So we do have a question come through in relation to credit lines. So what do we think is the reason for the increase in credit lines despite the delinquency risk that might be associated?
So we did see a very huge drop all through 2020 and 2021 in new card originations. There were hardly any cards being issued and at much lower credit limits. So a lot of it has to do with compensating for the 2020 and 21 drop in volume as well as credit limit. And now we have been seeing an increase in credit limits for new originations. But this quarter, if I compare it to last quarter, it is a small drop in credit limits. So the initial hike in credit limits for new originations is also slowing down.
Okay, thank you. I mean, I think I would definitely echo that as well. I think when you look back to that period, it definitely was a bit of a unknown. You know, COVID months. I think a lot of lenders didn't quite know how that was going to pan out. It was a really unusual, unique situation. And I think, you know, once there started to be a bit of stability, you know, when the deferral programs ended and actually looked as though there was a good recovery coming, I think that's maybe why some of the lenders gained some of the confidence and also offered some of those limits back again. So I think that's the only question we've had so far. Please do keep your questions coming in. We do like to kind of make this a two-way conversation as much as possible. But in the meantime, I will just switch into one of the things I get asked a lot, which is, are we starting to see the impact of interest rates yet? And if not, what should we really be looking out for? So if you've joined us for any of our historic webinars before, you will recognize the slide on the screen right now. This is where we look back to what happened from 2017 through to 2019. And this was really the last period that we saw of interest rate rises. And we did see some interesting things happen as we look back at that period. So in the first 12 months, which at that point was around 50 bips of interest rate rise, we saw the percentage of transactors on credit cards start to fall. So this was a reduction in the percentage of those consumers paying their credit card balance in full. So that was the first thing that we saw start to happen. Within the first 2 years, which was kind of around 100 bips of increase, we also saw an increase in insolvency rates, especially in those consumer proposals where those individuals have assets to protect, such as their own homes, and they're really trying to find a way to help them through that period of financial stress. And then finally, the third thing that we saw was a jump in non-mortgage delinquency levels, but that actually took several interest rate rises and several months to really start to see that come through. The biggest impact that we saw on the non-mortgage delinquency side was on those consumers that had high balance variable rate products, but we did start to see it across the board. Now, when we look at some of those early indicators and what's happening right now, If we start to look at the credit card side of things, the biggest story, as Swanema sort of started to talk about a bit earlier, is that we have seen this huge increase in monthly spend, and in particular in the last 12 months. And you can see that on that left-hand chart. So prior to COVID, the average spend on credit cards was pretty stable. You know, we do get seasonal peaks and troughs, but it was very consistent. Now, we know during those early months of COVID, when we had the lockdowns, there was significant drops, which I do love on this left-hand chart is that grey line that drops off. And although it took a while to rebound, for 2021, for the most part, it looked like we'd returned back to normal levels. Now, you'll see towards the back end of 2021, which is that red line, and into this year, which is the green line on the left-hand chart, we see that big rise coming in. And there's a couple of reasons for that. Firstly, we believe there's a lot of increased spend because some of the big ticket items that really were being held back on, things like vacations, they've started to come back onto the credit card side of things. We also know we have that large inflation, which is going to be increasing costs of goods. So prices in general have gone up, 10% perhaps, and that could be contributing to some of that. But we also believe there is some increased usage as consumers start to potentially rely on credit a little bit more for day-to-day expenses coming through. Now, if we break this apart into transactors, and those are really the ones that pay their credit card balance in full, what we do see on the right-hand side is you see there is a growth in the balance on transactors. Now, obviously, the balance comes through and then they instantly paid off. But we're also seeing quite an increase on revolvers as well. So these are the consumers who don't necessarily pay their balance in full. Now, of course, spend itself is not a bad thing. What's really important is how payments are being made against that spend. And the really good news is that so far, payments are also at a record high. So if you see that left-hand chart, it's a fairly similar pattern to what we're seeing on the spend side of things. But there is a but to that statement, because if we look at what's happening with pay rates, specifically on revolvers, we do see a bit of a movement. So when we look at pre-pandemic, we saw that actually the pay rate for that Revolve group was around 87 cents of payment for every dollar of spend. That's now fallen to 85 cents per dollar of spend. Now, that might not sound like a lot, but it's enough to see those balances start to rise. And it is maybe a little bit of an early indicator that perhaps there was a little bit of stress coming through and payments can't be made as much as they were. The big question then when we look back to some of those early warning signs from before is what's happening in terms of the transactor levels. Now, the good news again is that when we look at those levels and we look at transactor and Revolve levels, we're actually in a much better position than we were before the pandemic happened. So Revolve levels, which is the percentage of consumers who are not paying their credit card balance in full each month, is actually much lower than it was pre-pandemic. And you'll see that on that left-hand chart. You'll see the green line and the red line, that's 21 and 2022, and they've been fairly consistent since those lockdowns started to ease, and they remain much lower than we saw in 2019 and 2020. Now, we are seeing a little bit of an increase in the last few months, but we do believe that's really seasonality right now, so there aren't any alarm bells as such, and that's really very good news. However, like I mentioned on the previous slide, though, those pay rates, the actual amount of payment or the percentage of payments the revolvers are paying has dropped. So again, there could be some pockets of stress that are starting to come through. The second indicator we talked about was looking at insolvency levels, and Swanema mentioned this a little bit earlier as well. This is something that we saw start to increase during the interest rate rise period a few years ago. Now, at a high level, yes, we are seeing insolvency levels climbing compared to last quarter and to last year. But as Swanema mentioned, those are very low levels as a start point. So it looks like a bigger increase than it actually is. They still remain much below that 2019 level. However, when we look at this for certain age groups, and specifically on the consumer proposal side of things, because this is where we saw that stress start to come through last time with the interest rates when they increased, we are still a little bit concerned with those higher age ranges again. So that's 65 plus group. Now, typically, this age range maybe can find it a bit harder to manage through high inflation periods, as perhaps their incomes don't adjust in the same way as some of the other age groups. And they can, in some cases, carry high variable rate debt on products such as HELOCs. So you tend to have a higher level of homeowners, and they tend to perhaps use HELOCs in particular for some of their credit needs. Now, we are unfortunately seeing quite large increases on the insolvency rates compared to last year. and they're getting close to pre-pandemic levels for this age group. So again, there could be some start of some interest rate impact coming through. So what about the non-mortgage delinquency levels? Well, typically, we often see credit cards and loan products being the first that get impacted first from financial stress. And we talked earlier that we are seeing non-mortgage arrears increasing across the board, although they are still below those pre-pandemic levels. So one of the things that we've been looking at is what's happening with different vintages. So if you did join us in some of our previous webinars, you'll know that we did talk about some initial concerns around whether some of the people looking for credit right after some of those lockdowns start to ease and some of the COVID started to end in some of those regions, we thought potentially they might carry some additional risk. These two charts on the screen right now, they show the level of accounts missing a payment after 6 months of opening. And on the x-axis, that is the vintage, the opening date. The left-hand side is auto loans and the right-hand side is credit cards. And what you'll start to see on there is that some of those more recent vintages, so particularly from September 2021 onwards, we are seeing delinquency levels coming through a lot faster on those groups. So we are seeing some early delinquency much quicker, which does suggest potentially we could have consumers that are starting to feel financially stressed, that they're looking for additional credit, and unfortunately they are missing payments a bit quicker on there. So what does this mean for 2023? Now, when you look at kind of what some of the economists are saying right now, we do expect interest rates to rise again later on this week, unfortunately. And the general consensus seems to be that we're going to have relatively high interest rates throughout 2023 and perhaps into 2024. We might start to see them come down a little bit as we go into 2024, depending on how fast that inflation level starts to drop. So what does this really mean? Well, when we think about consumers, we try and bucket them into what their financial situation could be. So if you've got a high income versus low income, if you've got high savings versus low savings. And we know during the COVID months that there were lots of consumers that were saving very, very quickly, much higher levels than we'd seen before. And for certain income groups, we saw that jump up and stay up, and for others, we've seen that come back down again. So our big concern right now is really on those low income, low saving groups of consumers where they likely have used up any buffer that they had from the period during COVID when they had additional benefits or perhaps additional reduced spending, and potentially they may now start to become more reliant on credit. At the same time, if you have low savings and a high income, you might be a little bit more at risk. However, because you do have some income to prop that up, it's probably a little bit less of concern. So our best estimate in terms of for 2023 is, we do expect levels to likely return back to similar to pre-pandemic by the end of the year. Now on the screen right now, this is a bit of a simple forecast where if we look at what happened during the last period of interest rate rises, which was at 2018, 2019, if we literally just apply that to where we are right now, that is what it tells us. Towards the back end of next year, we're going to expect those delinquency levels to be back at a similar level to pre-pandemic. Now, having said that, that's a bit of a big but, because what we're seeing right now is we're starting from a much lower start point. We're seeing high disposable income and savings from the pandemic, which some consumers might still have as a buffer. And we're actually seeing much, much faster interest rate rises. So it could happen much quicker. We could see more extreme levels of delinquency coming through. And we still have that inflated cost of living. So although we can use what we saw historically as a bit of an estimate, it may not be completely what happens next year. Certainly, we expect to see delinquency rising, and we definitely would expect to see those delinquencies back to pre-pandemic by the end of the year, depending on what happens with inflation and how quickly we can get those interest rates stabilized or potentially back down again. That's really going to depend on what happens. Okay, so I know we have some questions coming through, but before we get to those, I believe we do have a polling question. So we do like to get you involved and get your thoughts on something. So we would love it if you all could come up with your answer to the following question. So what is the largest impact? I actually can't read it because I have animated reactions over my screen. I don't know, Swanma, can you read the question?
Yeah, sure. So the question is, what is the largest potential business risk that you have identified due to economic conditions? The first, increase in foreclosures, potentially impacting mortgage portfolio profitability. Second, more stringent mortgage renewal factors affecting consumer payment capacity. Third, higher loan amounts in the auto sector, potentially leading to an increased risk profile in applicants. And last, consumer risk profile starting to rise as government pandemic support begins to subside.
Amazing. Thank you so much. And apologies, I couldn't read that question. There was a clap. I think someone clapped at the news that the used car prices had fallen earlier, and that was over my screen, so I couldn't actually see it, although I do agree that is very good news. So we'll just give people a couple of minutes. So it is fantastic to hear what you think. So increase in foreclosures from the mortgage side, more stringent mortgage renewal factors, higher loan amounts. What is it you think is the biggest potential risk for your business? Okay, so I think we have around 50% of people have responded. So let's take a look at the results. Okay, so probably no surprise there. More stringent mortgage renewal factors affecting consumer payment capacity at 47%, and then consumer risk profiles starting to rise as government pandemic support begins to subsidize. Okay. So should we just go to the questions? Are there any questions come through, Swarnima?
Yes. So one of the questions is, do we expect the demand for credit continue to rise as government support and savings start to dwindle?
Great question. So I think when we look back historically, typically we would expect that to continue to increase, although we do expect that to really be a bit of a story of two sides. So there will be some consumers right now who are in a relatively good position. They have savings that they accumulated during the pandemic period. And even though inflation's high, they maybe aren't needing to kind of lean on credit. The flip side to that is going to be that there will be some consumers who are feeling some financial stress coming through, and they will become more reliant. And I imagine we will expect to see the demand for credit continue in that area. Any other questions?
We have a lot of questions. Maybe we move to Kathy's section and address them in the end.
Sure, absolutely, we can do that. So Kathy.
All right, thanks, Becky. And I guess the dominant sort of audience, given the fact that mortgage seems to be sort of front of mind, is a great segue to my segment. So thank you, Becky, and thank you, Swarnima, for sharing a lot of great insights with us till now, and especially around the outlook in terms of what we continue to happen next year. So as we saw this year, to curb inflation and to really cool the housing market, the Bank of Canada raised interest rates. So this resulted first in seeing, again, a slowdown of new growth in the housing market, especially compared to 20 and 21 when we saw historical highs. And second, more importantly, is these interest rate hikes having an impact on consumers that have existing mortgage payments with variable rates. So many are now and will be faced with hitting what we call their trigger rate. So before we go on, I just want to make sure we're all on the same page here. Let's take a look at sort of defining what the trigger rate is. So in simple terms, it's when a variable rate mortgage with fixed payments hits that inflection point where all of a sudden that interest portion of the payment equals the total payment amounts. So really nothing's going towards principal, or in other words, everything's going towards interest. So when this happens, we see lenders possibly taking a couple of different approaches towards their borrowers. The first might be that some lenders will automatically increase the mortgage payment so that it continues to cover the interest portion of the payment. And so with this approach, if interest rates do rise in subsequent months, the payment will also need to increase to cover that larger interest payment. So it kind of starts to look a little bit like that variable rate mortgage with variable payments. So that's one option. The next option might be that lenders just allow for the negative amortization, where the interest rate payment is permitted to exceed the total mortgage payment. And so principal payments are therefore negative. So the balance owed on the mortgage is actually increasing from month to month. Or last but not least, some lenders might take a more proactive approach where they reach out to the borrowers, telling them that, hey, you're reaching your trigger rate. Let's lock in that mortgage with a fixed rate, or would you like to make a lump sum payment so that it goes towards the principal? So now that we've got a good understanding around the mortgage trigger rate, let's look to understand a little bit around who's actually impacted, which borrowers are impacted. So as I mentioned, 20 and 21 were record high years in terms of the housing market because, again, ultra low cost of borrowing funds. Taking a look at our data, we saw that 2.5 million new mortgages were opened during that period, of which 30% had variable rates. And of these, 3 out of 4 were with a fixed payment, who ultimately are at risk of reaching, again, this trigger rate. So additionally, the other pocket of borrowers that are probably going to be impacted with these rising interest rates are those 1.2 million mortgages that are about 3 to 5 years old, and they're up for renewal in the next year, where close to 40% of them have a balance greater than $250,000. So many of these mortgages originated just before 2018 OSFI stress test requirement for the uninsured mortgages. So again, most of these mortgages would have had interest rates during this period that were significantly lower than what they're going to be faced with at renewal time. So quickly recapping what we've heard and really just taking a look at, as a lender, what you should be thinking about. So first off, we've seen the activity in the housing market slow down because of the interest rates. And again, home prices are still relatively high. The pace of the interest rate hikes have also clearly increased the risk around the mortgage market share that has variable rates. And also, again, if you've been following the news lately, according to the Bank of Canada, we've got half the variable rate mortgages with fixed payments have already hit their trigger rate. And again, for the mortgages that originated or renewed in 2021, just before these hikes, well, again, they could reach that trigger rate much earlier as well, given the outlook that more hikes are coming. So as a lender, now that you understand all this, what should you be mindful of here? Well, it's going to be more important than ever to really understand your consumer's overall financial position and if they're at risk. What does their capacity look like when it comes to being able to make higher payments, right? Have they paid off other loans and they look to have excess cash flow to cover off any increase for a mortgage payment? Or do they have other mounting debt? Does it look like their payment rates and amounts are going down while their debt climbs? Are they flipping from being a transactor to a revolver? Again, similar themes that we've heard throughout the presentation, but again, very important in terms of taking action. It's going to be important really to segment your population, using payment amounts made against their obligations to really understand their cash flow and really understand whether or not you've got this pocket of customers that are more at risk than others. Okay, so I'm going to move on from mortgage rates, and we're going to switch gears a little bit now and take a closer look at the auto industry, who, again, another industry impacted significantly during COVID because of the supply chain issue shortages on the semiconductors. So again, just to put it into perspective, during COVID, again, because of the shortages, we had less inventory in the market to buy, forced many consumers to look at the used car market as an alternative, but ended up, as a result, forcing both the new and used car prices up because of this surge in demand. So I'm going to focus in on sort of looking at more specifically the used car market and what we've seen from our data. All right, a couple of charts here for you. Taking a look at the chart on the left-hand side, let's start there. It's a time series, and it looks at the distribution of loan applications for used cars that were booked after a decline or after multiple looks. So let me just explain this concept a little bit. So look one, it's not on the chart, but it's for context, means that the lender or lenders approved it at first look. So therefore, basically, there was no decline on the application. Look 2 would mean a lender declined it before the next lender or lenders approved it, and so forth. And so from 2020 on, what we see here is this jump in the percentage of used car applicants that were approved after multiple looks, which kind of suggests that lenders have actually tightened up their risk criteria because riskier applicants are now asking for higher loan amounts or longer terms. Now, if we shift to the chart on the right-hand side, what we see here is the performance of these approved accounts based on how many looks they had. And right away, you can clearly see that where there was multiple looks, the delinquency rates are higher. So this means clearly as a lender, getting an application at a first look represents less risk. So looking at all of these insights and what this data is telling us, again, as a lender, what should you be thinking about? So again, to recap, we touched on, again, the whole supply chain issues impacting the auto industry, the shift to the used car market, and prices going up. Many consumers, as a result, were applying for higher loan amounts and possibly longer terms to pay it off. And then this is leading to some lenders really declining what they deem as risky and passing up on the applicant for another lender to look at. This is creating that surge in what we're calling multiple looks and flagging as riskier, given the performance we saw on the last slide. Conversely, from a new vehicle perspective, for loan requests, we have not seen that same increase in multiple looks as we've had with the used car market, as we just talked about. So again, as a lender, what does this mean and what can you do? So very important, it's going to be important to ensure your risk policies are optimized to give you more approvals and your response times are timely to give you more first look opportunities. Next, take a look at your performance metrics at a more granular level, like at a micro market level, to really understand the risk levels and are the risk levels and the optimal areas where you can possibly grow. Again, we heard Swarnima talk earlier today about the auto loans for used car markets are starting to fall, which means there may be a pool of consumers now with loans that are higher in value than what the asset is worth. Again, another risky pocket to monitor. And then last but not least, again, make sure your collection and recovery strategies are really primed to handle any influxes tied back to the market risks we just talked about. All right, last topic I want to touch upon today is really to revisit the consumers that took advantage of payment deferrals that many FIs were offering during COVID. So interesting population here. So again, back in 2020, COVID hit, we had many industries that were really impacted with shutdowns and loss of jobs. Government stepped in, offered CERB payments to those who qualified, and FIs offered deferral payments, which not only helped consumers stay afloat, but in many cases, it actually helped them get ahead. Reduced spending coupled with increased disposable income led to the ability for many consumers to pay down their debt. But again, we're seeing some stress come through now. So what you see here is we basically isolated the 3 million consumers in our database that had a deferral flag, and we saw that if there's a few leading indicators of financial stress that are coming through. 43% had revolved at least once on their credit card compared to the average revolve rate of 35%. And we had 1 in 4 deferred consumers that had a pre-COVID delinquency. We saw that of this population, 70% of them are actually starting to miss payments. So putting this collecting sort of these insights together, again, as a lender, what should you be thinking and what should you be doing? So as we recap, there's 3 million that had a deferral, about 8.4 million of these consumers also received CERB. Again, makes up a pocket where we've got individuals that were struggling before the pandemic and are unfortunately showing signs again of missing credit obligations. In addition, we've got inflation, higher interest rates, which have really put a lot of stress on households because cost of living has gone up so much this year. And we're seeing that whatever savings may have been accumulated during COVID for this pocket, it's being dropping significantly, especially if they're low-income families. So as a lender, here's some suggestions on what you should be monitoring. First, make sure you understand who in your portfolio had a deferral, not just with you, but elsewhere as well. Are debt levels rising? Overall, are payment rates and again amounts changing for this consumer? Is there behavioral changes in terms of seeking new credit, or is there higher utilization happening as well? Again, look for any and all signs of stress in terms of changing behavior, and get the latest information you can on your customer as part of a 360-degree view. Find ways to really be proactive so that you don't have a downstream collection or recovery issue. So I'm going to stop there because I know that there's been quite a few questions. So I'm going to pass it back to Becky, who's going to walk us through that.
Thank you so much, Kathy. Okay, so we do have a lot of questions coming through. Swanima, maybe you can help with a couple of these. So the first one was, are there any provinces where the number of consumer proposals and insolvencies are noted to be higher or lower than the peers?
So the consumer proposals as well as bankruptcy, they're higher across all across all provinces, and on average, it's up 25% overall Canada, but it's the Western and some of the Atlantic provinces that are showing the much higher than average increase in proposals.
Okay, thank you. Second one, I think, was in relation to the auto loans that you had on one of the slides. Let me just find that question. So in slide 16, so they're seeing growth in the 72 plus term loans. Do we know where that's coming from? Is it in 84 months or 96 months or longer? So I guess the question is, if you break out that 72 plus term bucket, is that changing at all? Are we seeing longer loans?
So 72 and 84, we are seeing an increase in the distribution of used car loans. Higher proportion of used cars are falling in 72 and 84. Normally it was much lower terms, but now it has not gone beyond 84. It's usually 72 to 84.
Yeah, and I think that's definitely one of the risk areas when you look at the auto book right now, because we do have some of these loans that have extended because we had this period of really high car prices, and therefore we've seen average loan amounts going up. They were being spread in a lot of cases over some longer terms. Now the challenge, of course, is as prices start to fall back down again, some of the residual value in those vehicles isn't going to be there. So if consumers do miss payments and kind of you do end up with a situation where they can't afford to keep up those payments at all on that vehicle, there will be less value potentially left in it because the prices have come back down again. So that is a little bit of a risk area on the auto side right now. We've shown a 30-day past due rate increase on credit card. Are you expecting those delinquent customers to roll through to 60 and 90 days plus? I don't know, Swanima or Kathy, any thoughts on that?
We are seeing an increase in 90 plus delinquency levels as well. Like it's not the same rise as we are seeing in the early delinquencies, but they are rolling into 60 and 90. And for this quarter, if you compare it to Q3 2021, we have seen that the non-mortgage delinquency rates has gone up. It is from 8.87% to 0.93%. So it is going up for later delinquencies as well. Yeah,
and I think, when you think about that, it does take a bit of time. I think one of the reasons we're focusing on the 30 plus a little bit more than we normally do. We really look at the severe financial difficulty of 90 plus. It's just because it takes a while. It takes a lag. It's an extra 2 months before you start to see it. So it is starting to come in. But the 30 plus is definitely more of a jump, and so we are seeing that come through. And yes, we do unfortunately expect that to continue. There was a question around how do the new buy now, pay later plans offered by credit card providers, such as Visa and MasterCard, impact spend, monthly payments, and balances. So I don't know, Swanima, if you want to start with that, or I can give some thoughts on that one.
So we are seeing an increase in buy now, pay later inquiries, but since we cannot track the consumer spending on buy now, pay later, it's difficult to say how much it has been impacting credit cards, because right now credit card spending is really high and it has not been impacted by any buy now, pay later options as of now.
Yeah, so I think this question is really around those plans that are being offered by lenders with credit cards. So I know some lenders right now, you can use some of your credit card limit as a buy now, pay later component. So certainly what we are starting to see a little bit on those ones is the scheduled payment amount. So in terms of the minimum that needs to be paid, that will vary versus kind of the more traditional percentage of a balance. We obviously will see some fixed payments coming through on there. I think to Swarnima's point there, how much that's really impacting balances and things. We haven't got those numbers right now, but maybe that is something we can look at and see if we can see anything interesting in those numbers for the webinar next time. Okay, let's see what other questions we've got in here. I did see one. Any insights on when house prices will finally start to decrease? So, Kathy, do you have any thoughts on that?
Well, I think, again, with interest rates sort of continuing to rise and the cool down of the market, right, I don't foresee a significant sort of, price drop. But what I do see is, again, that rate that we were seeing in terms of the prices increasing, it's really going to slow down. Conversely, I think from an affordability perspective, we will see a shift sort of in the condo market with perhaps condo prices, seeing growth there in terms of price points, just because, again, shift of demand, moving away from sort of the detached homes, will shift towards the condo market. So I see prices there increasing a little bit, but I don't see significant drop in home prices.
Yeah, and I know I was listening to one of the bank's economists recently. I know they were talking about, they were looking back through time and looking at some of those periods before where we've seen price adjustments. It doesn't tend to happen quickly, I think was the general summary. I think the most recent one, where actually it was considered quite fast, was still 2 to 3 years to really hit the low point in terms of the price drops. So, I think the extent of the rise in interest rates right now being so fast, I think is definitely going to impact. I mean, the reality is, I know Kathy mentioned earlier, you have, I think it was 50%, Kathy, you said, of variable rate mortgages already hitting that trigger point. That obviously is a concern, but the majority of mortgages are not variable rate, although we did see an increase in 2020 and 2021 of those. So, when you look forward, I think what's going to be a big catalyst or a big impact on those house price drops is going to be as you get consumers who are on fixed rate and they start to reach the end of their existing term periods, what happens then? Because even if you go back 3-4 years where we did have interest rate rises, the base rate was much lower than it is right now. It's around 200 bips lower at its maximum. So those consumers, as they come up to the end of their terms, there is going to be a price shock that's going to happen in terms of the amount of payments they're going to need to make and things like that. So I think it's going to be a bit of a staged approach and impact to house prices. So it could take a reasonably long time for it to hit the lows. And again, depending regionally, it's obviously going to impact certain regions faster than others, depending on what happened with those house price increases. Let me see if there's anything else. Do you follow pre-COVID delinquent consumers? And if so, are they the ones who now tend to be delinquent, or are these new delinquents? So that's a great question. I think, Kathy, you touched on that a little bit with some of yours, because I know a lot of the consumers that were delinquent pre-COVID, they were in that deferral population. So I think there is a big chunk that have gone delinquent, but I do believe we do have some new delinquencies coming through as well. So maybe, again, that's something we can bring to life in the next webinar in Q1. Anything else that's in here? Let me have a look. I think that's the bulk. Oh, there was a question on, do you see any change in credit card use in terms of frequency or amounts of purchase? So unfortunately, we generally just see a monthly snapshot, so we don't see the individual frequency. We have looked a little bit in terms of spend amount and distribution of spend amount. So we have seen those higher spend levels are rising, but we're also seeing an increase on the lower end as well. So it's really across the board in terms of what's happening there. Okay, so I'm conscious of time. I know we only have a few minutes left. So one thing I did want to just mention is we do have our small business credit trends and panel discussion happening on December 8th. So that is on Thursday, I believe. Sinead Gleason's going to be doing that. Again, we do always highly recommend attending the small business one as well as the consumer one. Small businesses obviously have a huge impact in Canada in terms of employment, so it can directly link into what we see on the consumer side. I know we had a lot of questions come through. Some of those we probably need to go away and kind of give you some more detailed answers to. So we will do our best post the webinar to come back to you and give you some answers on them if we haven't been able to. Apart from that, I know this is our last consumer webinar for 2022. So thank you so much if you've been joining us along the way. It has been an interesting year, and I'm sure 2023 is going to be just as interesting as we see what happens with interest rates and inflation. So please do join us in probably January, February time, as we will be doing our Q4 trends. And like I say, please do attend Sinead's session on Thursday. I'm sure it's going to be fantastic. Thank you so much to everybody, and we'll see you next year.